large one. Other countries have used tariffs against us for decades, and now it's our turn to start using them against those other countries. On average, the European Union, China, Brazil, India, Mexico, and Canada, have you heard of them? And countless other nations charge us tremendously higher tariffs than we charge them. It's very unfair. India charges us auto tariffs higher than 100%. China's average tariff on our products is twice what we charge them. And South Korea's average tariff is 4 times higher. Think of that, 4 times higher. And we give so much help militarily and in so many other ways to South Korea. But that's what happens. This is happening by friend and foe. This system is not fair to the United States and never was. And so on April 2nd, I wanted to make it April 1st, but I didn't want to be accused of April Fool's Day. That's not, just one day cost us a lot of money. But we're going to do it in April. I'm a very superstitious person. April 2nd, reciprocal tariffs kick in. And whatever they tariff us, other countries, we will tariff them. That's reciprocal, back and forth. Whatever they tax us, we will tax them. If they do non-monetary tariffs to keep us out of their market, then we will do non-monetary barriers to keep them out of our market. There's a lot of that, too. They don't even allow us in their market. We will take in trillions and trillions of dollars and create jobs like we have never seen before. I did it with China, and I did it with others, and the Biden administration couldn't do anything about it because there was so much money they couldn't do anything about it.
The announcement of reciprocal tariffs marks a significant shift in U.S. trade policy, aiming to level the playing field against countries that impose higher tariffs on American goods. The argument is clear. Nations like China, India, and South Korea have long benefited from imbalanced trade policies, charging the U.S. significantly higher tariffs than they receive in return. By enforcing reciprocal tariffs, the U.S. government seeks to correct these disparities and bring in trillions of dollars while protecting domestic industries. From a broader economic perspective, this move could have far-reaching consequences.
Joining us now with how the potential tariffs could impact the U.S. economy, former CFPB Director Rohit Chopra and former Trump economic advisor Steve Moore. Once again, we've got a big old debate set up with 2 people that hate tariffs. This should be really great. Who wants to start? Who hates them more? Rohit, you probably hate them a little bit more.
Tariffs remain a hotly contested issue, and with 2 strong critics, Rohit Chopra and Steve Moore, this debate is set to be intense. The key question: will tariffs protect U.S. industries or backfire by raising costs and straining trade? While some see them as a necessary tool against unfair practices, others warn of economic fallout. Let's dive into the potential risks and rewards.
No, actually, I'd say this. People want a fair trading system. They don't want countries to cheat. And I think where I would focus on is, why are we letting millions of small packages coming in with unsafe goods and even ingredients to make fentanyl go uninspected and mostly from China? There's no question that there is unfair trading practices that really affect our workers and our businesses. But I think people are a little bit confused. What's the fixation with Canada? And there are places where we want to make sure we're protecting our workers and our businesses, but we've got to be focused on it and actually stop some of this stuff from flowing onto our shores. And then on top of that, we really see that there's some fine print in some of these trade deals that is actually helping big pharma, big tech companies, and going against some U.S. policies to lower drug prices.
Fair trade is the priority, not just tariffs. The real issue isn't just economic competition. It's the unchecked flow of unsafe goods and even fentanyl ingredients, largely from China, slipping through inspections. While unfair trade practices hurt U.S. workers and businesses, the focus should be on stopping harmful imports rather than targeting allies like Canada. At the same time, trade policies are quietly favoring big pharma and big tech, working against efforts to lower drug prices. Addressing these loopholes is just as crucial as tackling tariffs.
Why can't we do it back to them?
Well, look, there's no question that Warren Buffett is right, that if you just raise tariffs across the board, then things will be more expensive. There's very little doubt about that. So Warren Buffett is right. But people forget that that isn't the only thing that Donald Trump is talking about. He also has what I call the untariff, which is that he's saying that he may raise let's say tariffs to 15%, but he's also going to say if you manufacture something here in the United States, he's going to lower the tax to 15%. So in other words, something made in, say, Dayton, Ohio or Charleston, South Carolina is going to cost less, but something coming in from, China is going to cost more. So the effect of that is kind of neutral. Now, I would make another point that, remember, just last week, we had a vote in the United States House on whether we should have a $4 trillion tax increase. $4 trillion. It would be the largest tax increase in the history of the United States. And every single Democrat in the House voted for a $4 trillion tax increase. And yet these are the same people who say they're worried about inflation. I mean, imagine what that would do to costs of Americans if we walloped every family, every business with this giant tax hike.
Reciprocal tariffs seem fair. If other countries impose high tariffs on U.S. goods, why shouldn't the U.S. do the same? Even critics might agree on leveling the playing field. The real question is, will this boost the economy or trigger trade retaliation?
The math doesn't necessarily make sense to me. Can you just sort of unpack that a little bit? I mean, if we're going to lower the tax on something made in Dayton, Ohio, the cost of labor, the cost of moving that manufacturing process here, the cost of having a manufacturing facility here will still be probably higher than 15%, even if you lower a tax.
Well, if you lower a tax, we just kind of established this. If you lower a tax, you're going to make things less expensive to produce. But
the inputs are more. The inputs are much more.
Well, then why would the tariff not have? I mean, a tariff is just a tax on things that come in from the United States. A reduction in the taxes here reduces the price of making things here. So what I'm saying is that you can't have a massive tax increase and not expect for that to have a big inflationary effect. And that's what Democrats, I mean, you have to ask, your other guess. Why is it Democrats would vote for a $4 trillion tax increase if they're worried about prices?
There's no doubt tariffs raise prices, as Warren Buffett points out, but Trump's plan adds a twist: higher tariffs on imports paired with lower taxes for U.S. manufacturers. The goal? Make American-made goods cheaper while making foreign imports more expensive. In theory, it balances out. Meanwhile, the debate over taxes continues, with a proposed $4 trillion tax hike adding to inflation concerns. The big question: will these policies truly help consumers, or just shift the costs elsewhere?
Well, Melissa, you're right that math really is a little messy, what we're hearing. The truth is this: there is a need for there to lower prices. And we have seen so many ways in which we can lower prices. I'm not really sure that's what's being focused on right now. We're seeing a focus on Canada, where instead there might be issues around how to lower the cost of food and so many other goods. And of course, this issue about where the revenues from tariffs going to go, apparently it's just going to be in more corporate giveaways and giveaways to the wealthiest people. So I think we should go back to the basics and say, what is the point of a trade policy? And we actually want a trading system where everyone is playing fair, where you're not sending in illegal chemicals to make fentanyl, that there's packages coming in with goods made through illegal labor practices. And I think we got to focus on that rather than the noise, and instead of not what families are trying to make.
The idea is simple: lower taxes on U.S. manufacturing to offset the cost of tariffs on imports. The logic is that reducing taxes makes it cheaper to produce goods domestically, while tariffs make foreign goods more expensive. But the real challenge is whether a tax cut alone is enough to cover higher labor and production costs in the U.S. The debate boils down to whether this approach truly balances out, or if it risks raising overall costs instead. Meanwhile, concerns over inflation clash with a proposed $4 trillion tax increase, adding another layer to the economic debate.
Steve, could God, if Rohit can find some things he likes about tariffs, you got to be able to find something. What about reciprocal tariffs, Stephen Moore? Who could not like reciprocal? If they're doing it to us.
The real focus should be on lowering prices and ensuring fair trade, not just targeting specific countries like Canada. While tariffs are being discussed, the bigger question is where that revenue will go. Will it truly help workers or just benefit corporations? Instead of political noise, trade policy should tackle real issues: stopping illegal imports, preventing unfair labor practices, and addressing the rising cost of essentials like food. The priority should be creating a fair system that protects both American workers and consumers.
Hit their budget paycheck to paycheck.
And I hear it all the time, giveaways to the wealthy and giveaways to wealthy corporations. And I never really, I mean, do you really believe that corporations can just be grouped in with the wealthy? If you lower the corporate tax rate to make U.S. corporations more competitive, and then they succeed globally and hire more people, and those people pay taxes, don't those taxes that the employees pay, don't they fund all the things the liberals and Democrats want to do? Don't they pay all the federal employees that you don't want to get rid of any of them whatsoever? Why are corporations, why is it bad to allow corporations to have the best shot they can at success?
Well, no, of course, that's not the...
But you call them corporate giveaways.
The idea that lowering corporate taxes is simply a giveaway to the wealthy ignores the bigger picture. Competitive tax rates can help U.S. companies grow, succeed globally, and create more jobs. Those jobs generate income taxes, which fund government programs, public services, and even federal salaries. The real question is, does a lower corporate tax rate actually translate into economic benefits for workers and consumers, or does it primarily boost profits without wider impact? The debate isn't just about corporations. It's about how tax policy drives overall economic growth.
What does that mean?
What I'm saying is that let's talk about that. There's sometimes in tax deals and in trade deals fine print that is allowing them really special favors. Look at some of the older trade deals that put into place fine print for pharma companies that was in direct contradiction to some of the efforts to get more generic pharmaceuticals in. Look at what is happening with some of the trade deals around big tech companies, direct contravention to what we are trying to do to foster more startups and more competition in it. So we've seen this over the past 20 years, and often it gets distorted by special interests rather than thinking broadly about what's the way to grow the economy.
Wait a minute, hold on,
Steve, you hear it all the time, don't you? Rich billionaires and corporations.
The issue isn't just about tax rates, it's about loopholes and special favors buried in trade and tax deals. Over the years, fine print in agreements has benefited industries like big pharma, limiting generic drug competition, and big tech stifling startups. These policies often serve corporate interests rather than fostering broad economic growth. The debate shouldn't be about whether corporations succeed, but whether the system is structured to benefit a few at the expense of fair competition and consumer choice.
Yeah. First of all, let's be clear. I worked for Donald Trump in his first term. Rohit worked for Joe Biden. Under Donald Trump, we had a 1.95% inflation rate. Under Joe Biden, the inflation rate was 3 to 4 times higher than that. So we actually conquered inflation. Inflation went up to 9% when Biden was president. So why would anybody, if you're going to do all these wonderful things to reduce inflation, if there's all these ideas out there, why didn't the Biden administration do them? Why did they allow prices to go through the roof? The other point I want to make is they keep talking about tax cuts for the rich and so on. The rich pay more, larger share of taxes than any time today than in history. And you're talking about a tax bill, a tax hike that Democrats voted for, everyone in the House, that would raise the tax on the average family by $3,000. I'm sorry, I don't understand how that's going to reduce inflation. Also, don't forget, virtually every small business in America got a 20% reduction in their tax. How is raising that tax back up going to reduce inflation? So job number one is to get the tax cut done so we don't have this giant tax increase. And then we can have tariffs, but we have to make sure they're offset by other tax policies that that benefit domestic producers, things that are made in the USA. Why would we tax something coming in from China less than something that's made in?
The argument is clear. Tax and trade policies should prioritize domestic growth. Under Trump, inflation stayed low, while under Biden it surged to 9%, raising concerns about economic management. Critics question why inflation-fighting measures weren't implemented sooner. Meanwhile, the debate over tax cuts for the rich overlooks that high earners already pay a larger share of taxes than ever, and a proposed tax hike would cost the average family $3,000. The key issue is balancing tariffs with tax policies that support U.S. businesses. Why should imports be taxed less than American-made goods? Policies should not just raise revenue but strengthen domestic industries.
Dayton, Ohio. I don't understand the logic of that.
Let's take a look at the futures market. Again, you're seeing some pressure across the board, the downward move coming on the heels of the sell-off that we saw yesterday as trade risks continue to rattle investor sentiment. You have stocks selling off. In yesterday's session, the NASDAQ actually led yesterday's losses, now down nearly 10% from its December high. You're also looking at further losses here ahead of the open this morning. You're looking at where it closed yesterday with the NASDAQ off just about 2.6%. Among big tech, NVIDIA, the worst performer among the Mag 7 names, that actually fell 8% to its lowest level since September. I believe right now you're looking at the early action here, the before the bell action that we are seeing with NVIDIA. That stock off just about 3% here in pre-market. Joining us now to break it all down, we want to bring in Nancy Tangler.
Markets are under pressure as trade risks continue to shake investor confidence. After a sharp sell-off yesterday, the NASDAQ is now down nearly 10% from its December high, with tech stocks leading the decline. NVIDIA took the biggest hit among the Magnificent Seven, plunging 8% to its lowest level since September. Pre-market trading shows further losses, with NVIDIA down another 3% before the opening bell. As investors navigate these uncertainties, all eyes are on the broader market reaction and how tech giants respond to ongoing volatility.
Laffer Tangler Investments CEO and Chief Investment Officer. Nancy, it's great to have you back here on Yahoo Finance. I'm curious what you make of this risk-off sentiment that we're clearly seeing play out in the markets. And then, of course, what we're seeing from investors, just this shift here towards negative sentiment.
Thanks for having me, Shauna. I mean, it's always excruciating when you're in the middle of a correction. And I think that's where we are. We're down about 5% from the highs. I think we could have another 5% to go. But the important thing to stress here is that we get a correction once every 12 months, and it's always spurred by something. And this time, of course, it's spurred by the tariffs. And I think we have to kind of analyze not just what the tariffs will be, but how long we think they're going to last. And I hope we start to get some indication. If they're short-lived, then this is just an opportunity to buy stocks for the long term. If we get an extended, robust, I guess you could say, trade war, then I think investors have to step back and say, where do I want to be exposed?
And how should they be thinking about that, Nancy?
Well, I think then you want to be domestically exposed to the extent that you can. So things like healthcare, financials, where we're overweight, REITs, maybe utilities, depends on the type of utility. Those would be places to be focused. But I think that defensive trade is just that, a trade. Because if you look at the whole AI revolution, and if you look at, I mean, there's so many cross currents acknowledged, and it's keeping me up at night. It's just like the first quarter of Trump 1.0, by the way. It was also equally as exhausting and chaotic. But if you think about, okay, what is the objective of DOGE? It's to improve efficiency and productivity of government. And that is going to be done through technology. So I think at the end of the day, the fears about spending cuts will actually inure to the benefit of technology companies. And then you have to say, is AI real? And will it have broad-reaching impacts? And we've seen it during the fourth quarter earnings calls that companies are saying that the use cases for AI is exploding. We're starting to see monetization. I read an article you probably read about how they're using AI bots to identify wildfires in the Western United States. I mean, the range of usage is really quite compelling. And I think this is an industrial revolution like we haven't seen for 100 years.
The current market correction, down about 5% from recent highs, is largely driven by trade concerns, with the potential for another 5% drop. The key question for investors is whether these tariffs will be short-lived or escalate into a prolonged trade war. If the latter, shifting towards domestically focused sectors like healthcare, financials, and utilities, could provide stability. However, the bigger picture remains centered on AI and technological advancements. Despite market volatility, AI adoption continues to expand across industries, with companies increasingly monetizing its capabilities. From government efficiency improvements to real-world applications like wildfire detection, AI is proving to be a transformative force. This shift is being compared to an industrial revolution not seen in over a century, suggesting that long-term investors should still keep a close eye on the tech sector.
And Nancy, coupling that with the strong earnings growth that we have seen for the most recent quarter, though I think the question for investors is whether or not it is enough to offset some of these macro concerns that we're clearly seeing play out.
Strong earnings provide stability, but macro concerns like trade tensions keep investors cautious. If earnings stay strong and AI innovation grows, confidence could improve. In the short term, uncertainty may keep markets defensive.
In the markets, what do you think?
Yeah, so I think, well, first of all, earnings are backward looking. So what we focus on is, of course, did they hit or beat? But what is the guidance? And what we've seen from many of these companies is that guidance for CapEx spending did not decline. In fact, some after DeepSeek, in fact, some of the hyperscalers, Meta and Amazon, actually increased their commitment to CapEx. The hiccup in the current Atlanta Fed GDP Now report, which just went negative 2.8%, is largely due to imports. I think we'll see that kind of, and so that's a tariff exposed area, and I think we'll see that kind of smooth out. But I think you're going to wish that you'd put some money to work in this period.
Earnings are backward looking, so the real focus is on guidance. Despite concerns, many companies, especially Meta and Amazon, have increased CapEx spending, signaling confidence. The recent GDP dip, driven by imports, reflects tariff exposure but may stabilize. Looking ahead, this could be a key opportunity for long-term investors. Now, if you found this video valuable and you want to diversify your investments beyond traditional stocks and bonds, I have just the thing for you. Even though I believe that investing in a low-cost index fund is the best long-term investment for the average Joe, the benefits of solid physical gold are hard to deny. I think of physical gold as insurance against unpredictable times, and I'm not the only one. In 2023, central banks added over 1,000 tons of gold to their reserves, the second highest annual purchase in American history. And in 2024, central bank got another 290 tons of gold in just the first 3 months of the year. If the biggest banks in the world are buying tons of gold, I'm sure there's a good reason for it. I found a company that allows ordinary Americans to own and securely store physical bars of gold as part of their IRA account. The best part is that they're giving away a free guide to teach you all about investing in solid physical gold. If you want to learn more about how gold can protect your retirement savings, just click the link in the description to receive a completely free gold IRA guide.